All right, everybody. We have a terrific panel here today to discuss new developments in pass-through voting. I'm going to start with some introductions, and then we're going to hear brief remarks from each of the panelists, and then we'll save time for some open-ended discussion across the panel and questions from all of you. So first, we'll hear from John Rowe, the Managing Director and Head of Investment Stewardship in the Americas at BlackRock. Next, we have Liz Kantrowitz, Head of Client Success for Investor Solutions at ISS. Then we have Danielle Guerrieri, a Vice President, Head of Bank Broker Dealer Product Management at Broadridge. And last but not least, Jonathan Zitnick, Associate Professor of Law at Georgetown. Okay, John, take it away.
Wow, that was a fast introduction. Hi, my name is John Rowe. As she said, I'm at BlackRock. I run investment stewardship here in the Americas. And one of the functions that we've been really focused on over the last 3.5 years is something called voting choice. Voting choice is really an extension of the philosophy that we've brought to investing for decades now, which is to give our investor clients choice of how they want to invest their money. And what voting choice does is it adds a dimension of that, which is how do they want their money voted when it comes to equities, public equities, voting proxies. Every time I turn my head, I think I come in and out. So I'll get a little closer here. So for a long time, our clients have been focused on proxy voting, a small subset of our clients. And many of those that have been invested in separately managed accounts have taken their own voting back and have owned their voting for years and years. I think I'm going to have to just talk straightforward because I keep hearing it coming out, in and out. So a lot of our clients, like I said, that have been in separately managed accounts have focused on voting their own shares for years. But we got a calling from more and more clients over the last 4 years or so that clients in commingled funds wanted the ability to also vote their own shares. And to that end, we stood up a program in 2021 where we allowed some of our clients in some of our commingled vehicles to vote their own shares. That program has grown, and today, 2.6 trillion of our 5.2 trillion in public equity under management is now eligible to vote their own shares. That's about half our public equity. We have found ways to enable those shares to be voted directly by their clients. We've evolved that number over time. The latest evolution in that number is we are running a retail pilot now. So if you're a retail investor in one of our funds, is our flagship S&P 500 fund, ticker IVV. You probably got an email a few months ago inviting you to choose how you want your shares to be voted in that S&P 500 fund. We continue to look for more and more ways to expand voting choice and to enable more and more investors to vote their shares the way they want them to be voted. Now, for our institutional clients that vote their shares, we give them 3 different choices on how they want to vote. The first option we give them is to choose a policy off the shelf. So if they want to take a policy from ISS or one of 2 other vendors that maybe we'll name later, we will allow them to apply that policy to their shares. Their shares get split off, and I'm going to let other people talk about the technical aspects. But their shares get split off and they get voted aligned with that policy rather than the BlackRock voting decision on those items. The second way we allow institutions to vote is to take back their voting entirely. So they can bring it in-house, they can stand up their own stewardship team, they can vote their shares however they want them to be voted. The third way is for a limited set of our clients, we have found a way to enable them to vote only certain items or only certain companies. So they can choose, they can come to us and they say they only want to vote companies in a particular sector, or they only want to vote on say-on-pay proposals, or they only want to vote environmentally focused shareholder proposals, and those get directed back to that client, and everything else stays with a different policy that they select. So we're trying to provide flexibility to clients as they exercise their voting rights. Now, the policies that we offer a set of 16 policies today for voters to choose from. That's up from 14 just 2 weeks ago. 7 of those policies are from ISS. Seven of them are from Glass Lewis, and 2 of them are from a third vendor you may not have heard of called Egan-Jones. Those are the 2 recent additions that we have added. We've publicly stated that we are trying to find more and more options for our clients to choose from. The addition of Egan-Jones as a vendor, as a policy provider, is evidence that we are doing just that. And then finally, we also have clients that have expressed a particular focus on decarbonization. They want us to go further than where we go today in our benchmark policy, voting on climate-related issues. And as a result, we have also stood up now another option, internally run at BlackRock, which is focused on accelerating climate transition. And that policy will be made eventually available as a voting choice option. It will be available to clients who have separately managed accounts sooner than that. So that's where we are on voting choice, snapshot of the picture today.
Great. Liz, on to you.
Thank you. I'll move this a little closer. I feel like I should have gone before John, but that's okay. First of all, thank you so much for having me here today and inviting me to participate on the panel. As mentioned, I am... Okay. I don't know how much closer I can... Is it on? Yeah. Okay. All right. I'll try to stay still. Okay, so as mentioned, my name is Liz Kantrowitz. I'm the Global Head of Client Success at Institutional Shareholder Services for our Investment Stewardship Division. I've been a part of the proxy voting space for the better part of 20 years. And it's been interesting to see the evolution, right, over that time horizon, where 20 years ago there was this initial, effort for managers to really concentrate their voting power and harmonize and centralize the process within their shop. Come maybe 10 years ago, there was a little bit of a pivot where it was like, okay, maybe we need to make sure we have all of our internal stakeholders participating in this process. So you saw, a lot of outreach to portfolio managers and making sure you had all of the various views incorporated in the vote decision, but still that harmonized voting power for voting decision from the asset manager. And then welcome a lot of external pressure over the last couple of years, 5 years, I would say, to really make sure that the voting is reflective of the underlying individual asset owners. And so welcome, pass-through voting. And to John's point, pass-through voting is not necessarily a new concept as it relates to separately managed accounts. That's something we've seen, as far back as 20 years ago, where an asset manager would have a mandate from an underlying client to vote their fund with a specific philosophy or policy. But that wasn't available in pooled vehicles. And so the technology, really came about a couple of years ago to enable managers to create these programs where they can offer choice, right, to the underlying shareholders. It's still the managers who design the program, right? They say who, they say what, they say when, they say how much. And when I say that, I mean, who, meaning the funds, what funds do they want to have participate in the program? The what policies do they want to make available through that program? When, what are the boundaries? Are there specific markets or meeting types that they want to kind of eliminate from the program? Maybe it's share blocking scenarios or conflict meetings, things of that nature. So they get to create sort of the boundaries of the program. And then the how much, to John's point, how much interaction do you want to allow that underlying shareholder to have with the physical ballot? Is it literally just, here's the policy menu, pick a policy that most closely aligns with your views? Or do you want to be able to actually case by case instruct on certain items on the agenda? And those are all aspects of the ISS vote preference program. The concept, again, to John's point, is pretty simple, right? You break out the shares according to underlying preferences of your clients. You apply the various policy recommendations and you roll that back up into a split vote. As Danielle will certainly attest to, and some of you in this room, voting proxies is never that simple. There's a tremendous amount of idiosyncrasies when you're voting proxies globally, market by market. And so the programs need to take into consideration not only the market mechanics, but also the parameters of the program that the asset manager would like to, include in their vote preference program. Switching to the policy selection, I think that, ISS is really most known for almost 40 years now in terms of providing proxy research and recommendations. We have two sort of separate buckets as it relates to the policies that we offer. The first bucket being policies that are maintained and owned by ISS. So I'd say a house view, but they're really reflective of a lot of stakeholder views. The first one being the benchmark policy. So when you see headlines in the news, ISS recommends this, or, in newspapers, that's the benchmark they're referring to, that particular policy. And that is intended to be reflective of the prevailing market view. So we do a lot of policy surveys, roundtables, engagements with various different stakeholder participants throughout the marketplace to try and make sure that that particular policy is a balanced approach based on all of the feedback that we receive and our own internal subject matter experts and the trends that they see. In addition to the benchmark, we have 7 additional thematic policies that we make available. And those really range the spectrum of sort of investor feedback choice. We know that investors are not monolithic, and you have everything from our socially responsible policy, which is really the most aspirational of all of our policies. It looks at matters on the agenda and says, why would we not do this? Where some of our policies are kind of coming from the other angle, well, why would we do this? So you have the spectrum of socially responsible to our sustainability policy, our climate policy, Taft-Hartley, public funds, faith-based, and then board aligned or global board aligned being sort of the other end of the spectrum, which is going to align more generally with the management or the board view, especially as it relates to E&S shareholder proposals. So our goal at ISS as a service provider is to be, reflective of market views and to offer choice that meets the demands. So if we see a growing demand for a thematic policy, that's something that we will, take into consideration, see if there's enough data available to build a policy that can be applied very broadly, globally, as all of our sort of house policies are designed to do. And then that other bucket that I made reference to is custom. And, the large majority of asset managers today are voting through a custom policy. And that is where they are independently setting all of the dials and telling ISS how they view, different matters, whether they're topical and also geographical, and how they would like ISS to analyze the data and produce recommendations on their behalf. And so those policies are owned exclusively by the asset manager for the asset manager. But as of, I think just the other week, I received an updated statistic where approximately 90% of all shares voted through ISS's systems are voted in line with a custom policy. Thematic has been custom and thematic have been our biggest growing products at ISS across the whole spectrum for the last number of years. Thematic being the close second to custom, where we've really seen a significant growing interest in ability to choose from this sort of range of policy selection. It's not always, though, for the whole shop, right? It could be there's this separately managed account that wants to vote with a climate policy or a board-aligned policy. And then there's the entrance of more and more asset managers who are putting out vote preference programs to their clients and then making the underlying thematic policies or custom policies, quite frankly, can be made available through a voting choice program as well. So I will leave it to Danielle to pick up. I'm sure, there's some overlap there too.
Yes, definitely. Let's see if I can get this. Everyone hear me right? Okay. So first, to intro, again, I oversee product management for Broadridge, and my team, my fabulous team, was responsible for launching pass-through voting a couple years back, and it has continued to evolve with all of our different clients' demands. But just some background about Broadridge, which many of you probably know about, but I think it's important as it relates to pass-through voting. Broadridge sits at the center of a lot of different corporate governance disclosure that takes place and connects banks, brokers, global custodians to the end investor. So any communication that's going out as it relates to shareholder mail, an interim communication, that annual, prospectus that you're reading, or obviously a proxy vote that goes out the door, Broadridge is sending it. We don't have a view on how you should be voting it or whether or not you do vote it, but we want you to participate. We want to make it easy for you to participate. And we do that service on behalf of banks and brokers, but as you can imagine, we're doing that for corporate issuers, mutual funds as well. So we are connected to all of the stakeholders, one way, shape, or form, involved in this process, including the end recipient of that proxy vote. So when pass-through voting started to become popular, it was always a topic, I feel, that was right teetering on the edge of whether or not it'd take hold. But when it started to become popular, a lot of our mutual fund and asset manager clients came to us asking how we can enable this solution. And of course, with BlackRock announcing their institutional pass-through voting, you can imagine the demand in the concept and understanding how it could work, growing thereafter. So for instance, the better part of 2021, 2022, everybody was focused on providing pass-through voting to the institutional client, which makes sense because if you think about from a competitive differentiator, the institution is the most interested to vote when you're thinking about institutions versus retail investors. But also there's a cost effectiveness to keeping a pooled investment vehicle, but still allowing that end investor to vote the way they would be able to for a separately managed account, which typically costs more for them to be in. So really democratizing the fact that you now no longer have to be this tremendous pension plan with a separately managed account or, huge institution to be able to have a vote. So it was a very powerful concept that BlackRock rolled out. And since then, we've definitely seen a ton of demand in institutional proxy voting. And I think Liz did a great job of underlying the mechanics there and how ultimately you're splitting that one ballot that comes through the door for an asset manager into multiples, ultimately based on the institution's preference. Then retail was the next hurdle, and clients are now saying, okay, well, we were able to do this for institutions. It's much easier for them to obtain a preference from an institutional client because it's their client at the end of the day. And it's, a handful or maybe 100 versus a couple of million. So how do we take this concept and bring it to the retail investor? A few firms started to adopt things like expression of wish, which wasn't a binding vote. It was like a poll to say, how do you feel about these topics around ESG, or can you give me your preference in voting? And maybe I'm taking it, maybe I'm not taking it. That didn't last very long, as you can imagine why. And ultimately, people started shifting towards giving the retail investor a binding vote. And what Broadridge does there is we leverage that connection with all of our banks, brokers, and global custodians so that when an asset manager comes to us and say, we want to offer the IVV investors the ability to vote on the underlying proposals, on the underlying equities that make up that fund, we ping our broker partners and we say, who owns this? They come back to us and we send out that communication in a neat microsite trying to simplify but give as much transparency as possible. It's a really fine line because you want participation, but you also don't want to give so much information that they don't want to participate. For Broadridge, we're just the technology behind it. We're the page that displays the information. As Liz had said, it's all driven by the asset manager in terms of the language, the policies that are offered, the funds that are offered. And we've seen a huge uptick in the amount of funds wanting to offer retail pass-through voting. And that's been an interesting journey as well. And everyone went from pilot mode, let's see how this looks with 1 to 2 to 3 funds, to how do we get this across the board so that there's this principle of fairness and all of our investors are being given the opportunity to participate. And it's definitely been a very interesting journey. And I know there's some more questions around mechanics later. I'll see.
Great. Thank you so much. I'm John Zitnick. Thank you so much to Jeff, Dorothy for having me on the panel. Among other things, I do empirical research on shareholder voting, which I'll talk about today. But I'm especially excited to be on this panel because we're talking about something new, something that's happening now. So as an empiricist, I study things that have already happened. This is a very welcome change for me. The only downside to talking about something new is I don't know anything because it hasn't happened yet. We'll know stuff in a couple of years, or at the rate I work, maybe 7 or 8 years. But this conference is today, so I thought I'd use my 13 or 14 minutes by sharing a few questions I have about pass-through voting, and then I try to shed some light on these questions by looking at results from some of my own research. So here are the questions that I have. First question is about the rationale. What's the purported problem that pass-through voting is trying to solve? Second question is about take-up. Under what conditions will individual investors use it? Third question is whether those pass-through votes capture individual investor preferences. I'm going to share just a few research results. Some of them are from my work on individual investors with data from Broadridge on individual investor ownership and voting directly and mutual funds from 2015 through 2017. So thank you, Danielle. Later, I'll be talking about a different project using data from Glass Lewis. John, Elizabeth, not too late to get in on the data sharing game. The goal today is breadth over depth. So I'm just going to very briefly give some top line results. And let's start with my first question about the rationale for pass-through voting. So the concern in some quarters is that funds are voting differently than the preferences of their underlying investors. So these concerns tend to be focused on environmental and social proposals, or ES proposals, we'll call them, where there might be more of a preference gap and less of an information gap between mutual funds and their customers. Now, I can't tell you whether that's a good thing or a bad thing, but I can explore whether it's true. So one way to frame this as an empirical question is as follows. We know different mutual funds vote very differently from each other. And Rob Jackson and I show in a paper that individual investors vote very differently from each other as well. So individuals tend to vote consistently with management or consistently against management. If you vote in favor of one environmental proposal, you're probably voting in favor of just about all the environmental and social proposals. So in political science terms, institutions and especially individuals are ideological, which means that if you know some of their votes, you can predict the rest of their votes. So individuals are ideological, institutions are ideological, not as ideological, they're ideological. So a question we might ask is, do individuals sort into mutual funds based on their ideologies? Let's look at what that might look like using made-up data. So one could imagine that given how ideological these individual investors are, and given how many choices there are for similar mutual funds, they might choose funds that match their ideologies. So in this illustrative figure, each dot would represent a mutual fund. So you'd have the fund's ideology on environmental and social proposals, that's on the y-axis, and the ideology of the customers of that fund, the average ideology on the x-axis. And in this illustration, individuals sort into funds by ideology, with the funds with the most pro-ES ideology tend to have the most pro-ES customers. So let's see what it actually looks like. So each dot shows a fund's votes and its customers' votes. And there's essentially no relationship between an individual's ideology and mutual funds she chooses. So individuals are ideological, and mutual funds are ideological, but an individual is no more likely to choose the fund that matches her ideology to one with the same strategy that opposes it. There's an exception for ESG funds, those are the red triangles, but those are a small fraction of total assets. So that takes us back to the rationale for pass-through voting. It might be easier to vote than to find a mutual fund whose votes align with your preferences. So for that reason, it might make sense to just give these individuals the keys to the car. All right, let's turn to the second question. Under what conditions would we expect individual investors to take this up? Well, I have no idea, obviously, but we've got a few minutes, so let's speculate. So in Brov, Kane, Zitnik, we looked at individual investor turnout for their direct holdings. And we find that 11% of individual investor ballots were cast. Because investors with more shares are more likely to turn out to vote, that comes out to about 33% of shares cast. So that seems like a decent starting point for estimating the fraction of individual investors that will use pass-through voting. Now, something we find in the paper is that individual investor turnout is quite sensitive to variation in the costs and benefits of voting. Let me give you an example. Shareholders can always vote by internet. But for shareholders who don't check a certain box, companies can effectively choose if the materials that the shareholders receive also include a mailable ballot or telephone number to cast your vote. Shareholders can always vote by mail or phone if they really want to, but they have to request a mail ballot or a phone number first if the firm didn't send them one. So if a firm chooses not to send mail ballots, that increases the hassle of voting for some shareholders. So let's look at what happens to turnout when their company in 2017 switches them from not having those options to having those options. So we've got turnout on the y-axis. And before the 2017 switch, before their company switches their methods, turnout is flat. And then after the switch, when their company sends them mail ballots in 2017, their turnout jumps. Same thing, companies that switch in 2017 from sending mail ballots to not sending mail ballots, before the switch, turnout is flat. And then after the switch, there's a drop in turnout. So individual investors react to the ease of voting. Now, why does it matter if individual investor turnout is sensitive to the costs, to the hassles of voting? Well, voting is going to look very different in the pass-through context than it will in direct voting. Since it's basically impossible for retail investors to vote, thousands of portfolio companies. So in particular, it should look a lot, it should be a lot easier to vote in the pass-through context. And in practice, I believe every institutional investor to offer pass-through voting is really offering a sort of intermediated ready-made packages. We were hearing about these with the thematic packages. So you don't cast individual ballots. You might choose to follow ISS recommendations, but you're not limited to the benchmark proxy advisor recommendations. So you can choose the ESG voting package or the public pension voting package, which may be run by the proxy advisor, perhaps in some cases run by the institution itself. So these pre-made voting packages might be the key to making this work. What do we know about it? Well, it turns out that institutional investors already have the option to select these ready-made voting packages. So I want to switch gears and talk about a new paper of mine. It's co-authored with Nadia Malenko and Eddie Hu, called Customized Proxy Shareholder Advice, which uses data from Glass Lewis. Now, the main focus of that paper is about how, in contrast to the literature, which focuses on benchmark proxy advisor recommendations, proxy advice is actually a two-way street. So the use of customized recommendations, as Danielle already said, is very widespread. I'll avoid going into the paper in too much detail, but there's three things in the data from Glass Lewis that are relevant for our purposes here. So first, we observe whether the investor receives only Glass Lewis benchmark recommendations, whether it has fully customized recommendations tailored to the specific investment fund, what Elizabeth called custom policy, or whether it has these ready-made packages like ESG or public pension, what Elizabeth called a thematic plan. So this is the type that individual investors are gaining access to for pass-through voting. Second, we see something about the fund's process. So we have a good proxy for whether the fund is manually submitting its vote or auto-submitting in accordance with the recommendations it receives which we can take as a measure of effort or attention to the vote. And third, we see something about the fund's voting outcome, specifically whether its vote deviated from the Glass-Lewis benchmark. So we see something about the process and we see something about the voting outcome. Now, most funds get either only benchmark recommendations or they get fully tailored, customized recommendations. So only about 350 funds in our data receive the ready-made packages, that's the green, as compared to about 20,000 funds that receive the fully tailored, customized recommendations. But that's still plenty. So let's look at how funds cast their votes. And we'll compare the investors, the green ones, who receive these ready-made recommendation packages to the investors who pay less and receive only the benchmark recommendations, the white wedge. Now, I'm about to show you a binned scatter plot. So each dot is going to represent a big clump of funds. So you can think of this as a scatter plot that's full of averages. So it's the idea is to have much fewer dots than a regular scatter plot. And on the x-axis, we'll look at how frequently a fund manually casts its ballot instead of auto-submitting. And on the y-axis, we'll look at how frequently the funds deviate from the Glass-Lewis benchmark. So let's start with funds that don't receive a custom recommendation at all. A lot of them auto-submit most of the time. We've got a lot of dots over on the left, but there's a decent spread. And they tend to follow Glass-Lewis benchmark recommendations pretty closely. The dots are low on the graph. Now let's look at funds that subscribe to these ready-made packages. So these funds are in the upper left. We can see that they're manually submitting less, yet they're still deviating from Glass-Lewis benchmarks a lot more. So one thing we can conclude from this is that institutional investors use these ready-made voting packages as a labor-saving device. And they seem to allow investors to have a wider range of voting choices, but they also don't require investors to manually cast all their votes. So we can imagine something similar with the pass-through voting options that individual investors get. So how will these ready-made voting packages do at capturing individual investor preferences? Well, I'm sure they won't be perfect, but I already mentioned that individual investors are extremely ideological. An individual tends to be very consistent across their votes. And we saw that for institutional investors, these ready-made voting packages let you get a wider range of ideology with less effort than just the benchmark recommendations. So let's wrap up by returning to my 3 questions on pass-through voting. First question was, what's the problem that pass-through voting might resolve? I show that individual investors and their mutual funds vote differently. Second question, under what conditions will individual investors use it? Well, maybe if you make it easier for them, takeout will be high. Finally, how will they do at capturing individual investor preferences? We've seen that for institutional investors, these ready-made packages can serve as a labor-saving device, and individual investors tend not to have fine-grained opinions on individual proposals anyway. So maybe these packages will capture most of what we want to capture, but that's for future study. Thank you. I'm looking forward to the panel.
All right, thank you. To kick off our discussion, I'd love to hear from John a bit more about what the impetus was for the rollout of pass-through voting at BlackRock. And I've heard different things. One narrative that I've heard is that it's had to do with the political environment in the United States, or that there are these new EU directives that required asset owners to give more guidance on voting, and that this all may have influenced things. But tell me what I'm missing.
I think the simple answer is clients wanted it. Clients wanted the option to vote. Clients who were in SMAs and commingled vehicles also wanted to have their shares that are in commingled vehicles to be able to be voted in the way they wanted them to be voted. And clients that weren't saw what the SMAs were able to do and asked us, can you do that in a commingled vehicle as well? I think it's as simple as that. There's not a nefarious political, aim to this.
And is the same true for retail investors? I know you said you're expanding now to a pilot program. Were retail shareholders coming to you and asking for this as well?
We had some that were, yes. We had consultants that were coming to us and saying that their clients were looking, the end investors that they were selling shares to and advising were looking for it. The retail is very early still. We're only a couple months into that effort. So not a whole lot of information on that yet.
Okay.
About $200 billion of assets, though, of retail have been enabled.
Wow, very interesting. Liz, I'd love to turn to you and ask some questions about how exactly ISS translates guidelines into actual votes and the discretion you have to depart from things. Imagine you have your solicitation reveals that some people have selected the sustainability policy. Could you then direct votes against a shareholder proposal seeking additional environmental disclosure if maybe you thought this wasn't well worded, this wasn't well thought out, maybe we think this issuer's disclosures are sufficient as is, or maybe it's not going far enough. So I guess, and then maybe another way of asking this is, what's the process within ISS to figure out whether a given issue item is pro sustainability or not?
Sure. So what I'll start by saying is that, ISS does not have any, vested interest in the outcome of these meetings or these votes, right? We're not an activist. We are a service provider, and we are a policy-driven organization. All of those policies are publicly disclosed on our website and go into significant detail on the methodology that is used to analyze each item that comes up on a ballot and through each individual lens, right? So every policy has its own policy documentation that is published on our website. And as a policy-driven organization, it's really easy for people to check us, right? Our clients to tell us if they think that we're straying. Companies, right? The public to tell us if they think we're straying from our guidelines. We do have a fair amount of sort of case by case analysis in each of our policies, but the methodology and the things that we look at are very clearly articulated because we want to make sure that we're able to factor in each company's specific set of circumstances, the market that they're doing business in, things of that nature. So I think really, again, we're a service provider. We're providing this research and these recommendations to our clients based on the policy they select, right? It's up to each client to determine which policy they want to use, whether it's thematic, benchmark, custom, which ones they want to offer in a pass-through voting program. We're really beholden to that as a service provider to make sure that we have the quality of our data, our methodology, our research process when we're producing these recommendations.
Great. Okay. So what I'm hearing you say is that these policies are designed and then they're applied to the votes, and that people can look and see, and perhaps if they don't like it, they can give feedback or switch from one policy to another.
Yeah, and clients can always override their vote, right? So in some of the graphs that Jonathan was showing, Ethan, we're going to call him, it's almost hard to distinguish. You're saying they're varying from a benchmark, but if you don't know what the policy recommendation was that they're following, it's not clear how closely they are aligned with their own policy, if they've actually instructed contrary to their own policy recommendation, or if they just happen to read the research and agree. Because even though not everybody is able to hit the button on all 10,000 securities that they hold and the hundreds of thousands of agenda items, we do see a lot of investor oversight into their program where they're reading the reports or they're using different alerts and triggers within our systems to make sure that items that are non-routine are being brought to their attention so that they have that specific oversight, and clients can always submit an instruction that's contrary to the policy recommendation that they've elected.
Right. Okay. Thank you. I'd like to turn now to talk a little bit about the fiduciary duty issues that may or may not accompany pass-through voting here. So, fund managers are fiduciaries. They have a fiduciary duty to cast votes in the investor's best interest. So what happens if you have an investor that's pushing in a direction that you don't actually think is moving, it's, prioritizing its economic interest? And so we didn't get to talk about the new provider of guidelines, Egan-Jones, which is, I think, it gives investors a set of guidelines that allow them to choose the anti-ESG voting policy. Is that right, John?
No.
Oh, okay. I'm glad I asked. Please
Yeah,
fill me in.
there are the wealth-focused policy from Egan-Jones is the one, and I'm not here to defend Egan-Jones policy. But there are different gradations of what you would say is anti-ESG. The Egan-Jones policy basically says we don't support any ESG proposal, whether it be from the far left or the far right.
Mm,
So it doesn't matter if it's NCPPR, NLPC, the far right proposals. We don't support any of those, and the far left proposals, stop fossil fuel now. We don't support those either. So it's basically, we don't think this is an issue that we should vote on. Not that we're trying to walk back things.
great. Okay, that's helpful. I guess, is there any fiduciary duty limit to how far pass-through voting can go? Or is there any situation where you might feel compelled to disregard somebody's choice?
There are. Every policy that we implement on behalf of clients goes through a fiduciary review to make sure that it satisfies. I won't opine on what the conditions are when we would say that, it breaks that, but we do carefully look at every policy.
Right, okay. Danielle and Liz, I'd be interested from hearing both of you say a bit more. I mean, I think we have a sense now of what BlackRock is doing. Are other asset managers also taking on voting choice, and are we coalescing on a similar approach where you have a custom option, some guidelines options, expanding all the way to retail, or is BlackRock unique in this respect?
Yeah, absolutely. So first, one thing I did want to touch on the approach, and after your presentation made me think how important this concept was, is the ease of voting and how important this has become in allowing retail investors. So when you own a corporate issuer or an equity directly, you as an individual investor don't have the ability to automatically vote. You have to go on to the website and do some of the materials and then submit a vote. For institutions and asset managers, given that they're voting thousands and thousands of ballots, they have this ease of voting where they're able to do extensive work up front, choose a policy, apply it, there's obviously tons of tools in place to ensure that they're voting according to that policy. It's not a set it and forget it by any means. But because now you as an individual investor own a fund and the fund is submitting the vote, you have that similar capability because ultimately the fund still owns the vote. So it's up to them to get it right and do that upfront fiduciary work to make sure that the policies they're putting in front of you to choose are according to their standards. So as an individual, what we're able to do on behalf of asset managers and funds who are employing this is we can send you an email or a printed notice if that's your current preference for delivery, where you'd scan a QR barcode or you click a button on an email and you would see a microsite. And in that microsite, you're going to get however many policies the fund wants to offer you, whether it's in some cases 4, in other cases 14. And when you pick that policy, it can apply to the 500 or 1,000 equities that made up in that fund. Because as Jonathan had said, if you're asking them to vote on 1,000 equities, the answer is a hard no. No one's going to do that. So you have to kind of encourage this ability to subscribe to a policy and apply to all, which is really interesting because it's the first time a retail investor is allowed to subscribe to a policy. Because ultimately it's going back to the asset manager at the end of the day. So that has been the most popular model. Originally there was some interest up front, early days when people are exploring proof of concepts, to say, let's give the investor the ability to create a custom policy. And then not naming any names in particular for asset managers, but ultimately said, wait, we can't do that because then we're going to have to evaluate every single vote, what this means. At the end of the day, if it's extremely nuanced, it could go against our fiduciary responsibility and what we believe ultimately should be voted. So the idea of a custom policy for a retail investor went out the window. Then it was, okay, well, we want to provide, the policies to choose from, but the amount of information that we put in front of the investor is really important. It has to be really clear how this translates ultimately to a vote, because they need to be made aware, ultimately how what they're selecting translates to a vote on the ballot. So I would say what we're seeing in trend is a continuation of the policy preference for the investor. I think that will stick. But the amount of information and given to a retail investor over time will continue to increase. Follow-up reports to say, what does your season look like? A season in review type of thing. This is your policy was this, and this is how this translated to your ballots. And here's a cute little summary on like what that means from a category perspective. So asset managers for passively managed funds has been the predominant party of interest, but we do see active managers, specifically, I can quote one that says, well, we're not going to be the first to adopt it, but we're not going to be laggards either. So I would not be surprised if active managers took part even as soon as next season, and it should continue to grow.
This made me think of Jonathan's paper, and your answer made me think about Jonathan's interesting finding about the ease of voting, really encouraging retail shareholders to vote. And I'm wondering how much this translates to individual shareholders in mutual funds who are opting into pass-through. So when you're a shareholder of a mutual fund that maybe has hundreds of different investments, and I wonder, Jonathan, if there's anything from your research that would maybe help us all think through how could you design these programs in a way that would really increase the uptake rate or increase lessen the gap between the individual investor and the ultimate vote.
Yeah. So I think Broadridge is going to just have some extent like internal information that's going to far exceed my own. But a couple of themes are apparent, I guess, from what I've seen. So first off, voting methods matter. So if you have to go on the line and like type in a URL from a piece of paper, you're going to get less turnout than if it's emailed and mailed and all of the above, and you have all sorts of abilities to cast your ballot. And then this is extrapolating from institutional investors, but I think the ability to set policy like we've been discussing is just going to make a world of difference. I can imagine even a shareholder with strong political ideologies whose ideologies would translate into votes on, let's say, E or S, might not really know how to vote those actual proposals in for their direct holdings, whereas they might very well be able to select the ESG or the opposite of ESG if it exists options. So I think that policy setting is going to make a huge difference.
Okay, great. I want to now ask a little bit more about the client, because I think early on, Liz and John mentioned this is very client driven. Clients came to you wanting this. Their input from clients has helped figure out the sort of guidelines that are offered. And I know you don't have exact numbers on uptake rates, but which clients are the most likely to ask for this? And I can think about some different dimensions to explore: international versus domestic, small versus large shareholders, retail versus institutional shareholders, pension funds versus other types of institutions. So who's coming to you and wanting this and taking this on?
Right. So I can give you some numbers. In my opening remarks, I talked about 2.6 trillion eligible for voting choice. Today, there's 598 billion that has opted in to voting their own shares. Of that 598 billion, 249 are true what you would call voting choice. Since we introduced the program, they've opted in and selected a policy, or they've taken the vote back themselves. The remaining 349 billion were in SMAs voting all along. So, that's numbers. In terms of uptake, that's exactly what it is. And we report the numbers on a basically quarterly, but little less than quarterly basis on our website. The second question we get, which is related, is what policies are they choosing? And the answer is it's literally all over the board. The plurality of shares that have opted in so far have chosen to put their own policy into place, often with ISS operating that policy for them rather than them hiring a stewardship team and running it themselves. For those that have chosen a policy off the menu, it's really all across the menu. It is SRI, it is board aligned, it's it's a grab bag, a little bit of everything. In terms of who they are, they're U.S. domestic, they're European, they're left-leaning, they're right-leaning, they're pension money, they're not pension money. It's really all over the board. And then in terms of retail, it's early yet to talk about that. We're just a couple months in. I will say we've had, compared to what we originally thought, we've had fairly strong interest. So we'll see where that nets out. That's only 200 billion enabled so far, though. Smaller chunk.
Dorothy, can I just say one comment on that is, the interest from retail investors is one thing, and that's absolutely important. Everybody wants to know how many participants have taken place. But what I find interesting from asset managers is it's not always really about how many partake, it's that those who want have the opportunity.
Yes.
And that seems to be the biggest driver is it's not, getting to a certain threshold to make this worth it. It's their money. They should have a choice in voting it. So that's
Great, very, very helpful. I know we're in early days here still, but I think this is potentially, very big. And I'd love to know whether anybody here can comment on whether we've seen an effect on voting outcomes. And I guess part of this question entails, how often are these votes going differently than BlackRock would have gone, or that, and if we're seeing differences, are we seeing, changes in the game for shareholder proposals, ESG matters, proxy fights? Yeah, John, maybe I'll start with you with this one.
Yeah, I think if you looked at the data in aggregate, if you did an empirical study, you would probably find that the votes across most items actually line up. I think most of the policies are actually fairly similar on most ballot items.
Yeah.
The election of directors, what defines independence for a director, what looks like a good auditor to ratify, the report of the auditor. Most of the items are the same. Where you see a lot of divergence, though, is on the shareholder proposals. A little less divergence, but a lot still on stay on pay proposals. And then, there's divergence at the margin on everything else. If you looked at those shareholder proposals, the E proposals and the S proposals in particular, that's where you would see dramatic differences in what is supported and what's not supported. Probably as you would imagine. Our website, I'm not trying to plug our website, but our voting choice website actually has a map of the 14 ISS and Glass Lewis policies and how frequently they vote for or against on a comparative basis, different types of items. So you can get some idea looking at that.
Very cool. Danielle, Liz, do you want to jump in here and talk about the impact?
Yeah, I was just going to agree with John that I think it really is in the margins where you would potentially see some impact. And I think that's true for shareholder voting across the board. The vast majority of shareholder meetings are very routine. And so you're not going to see a tremendous amount of disagreement amongst shareholders or policies in how to recommend the overwhelming majority of proposals that are up for a vote. So it really is in the margins where there's either some type of egregious failure, risk oversight issue, or maybe industry specific, ENS shareholder specific, but still in the margins where you're going to start to see a lot of divergence of views. I think it's still a little too early to see the impact of vote preference on meeting outcomes. But if we were to long-term, I agree it would be in the ENS shareholder proposals. We do an analysis post-season every year, so we're not quite there, sort of on the eve of post-season. So it takes a little while to crunch all of the meeting results and take a look at sort of our shareholder proposal retrospective. But I'm sort of venturing to say at this point, we probably won't see a material impact from vote preference. But maybe as the retail view continues to come on board, Maybe as we see more and more managers, and there is global interest in offering vote preference programs, we could perhaps see a larger impact on meeting outcomes.
Just to hang a number on that, in the US, we vote about 37,000 ballot items a year. About 300 of them are ENS shareholder proposals. Fewer than 1% are where there's a lot of differentiation.
Danielle, do you want to add or?
For Broadridge, this is our client data, so we won't
Okay,
opine on
Don't
any
divulge secret.
on the way in which it's going. I just know we issue all similarly after proxy season, our proxy pulse report, which shows all the breakdown between, in general, not pass-through voting specifically, but institution and retail investor voting preferences. And we do see of the 33% of shares from retail investors, and I like that stat, it looks familiar. They largely vote with management. Not to say that that's what pass-through voting is going to happen, but that what happens today with individual investors for corporate equities.
I want to insert one comment because I don't think we should undersell the importance of this, because even if it's just 300 shareholder proposals a year, these are really key issues that are facing companies. And yes, there's a lot of, we'll go all the way to say boring, routine voting that happens in corporations every year. But, these proxy fights, these ESG shareholder proposals can really be a big deal. And so if we're seeing a different outcome for 300 shareholder proposals a year, that would be a huge change. I think maybe
I think the bigger change, though, isn't the shareholder proposals.
Yeah.
That it is that more and more of these policies are starting to lean in on director elections, getting directors' attention on these issues.
Yeah.
And I think that's the place to keep an eye on in the future. That's your work 10 years from now.
Jonathan, I was going to give you the last word here before we turn to the audience, just to talk, because everybody here is being careful and not saying which direction we think this is going to go. But I know your research probably tells us, if we see more and more voting choice happening, what's going to be the effect on shareholder proposals? What's going to be the effect on management's incentives to respond to shareholders or interface with proxy advisors? I wonder if you can opine a little bit on what you think the impact of this could be.
Yeah, so let me give two answers, sort of like the maybe a macro answer and an edge case answer. So macro answer, my numbers I think maybe look a little bit different from John's, which makes sense because they're one institution and I'm looking at a lot. The big difference that I find between retail investors and institutional investors is actually not in the ENS, but in the governance proposals. So I'm not sure, at least as of when my data ends, if you waved a magic wand and gave those retail investors pass-through voting, I think fewer shareholder governance proposals passing might be the immediate effect. Now, I mentioned, so that might be the macro answer. Of course, we all remember GameStop. We all remember there's weird edge cases, and a lot of times with these proposals, we're not talking about the average proposal. We're not talking about the 50%. We're talking about the unusual ones, the ones that get a lot of attention, the ones that make the news, and there I think there's real potential for different results in maybe unpredictable ways.
Awesome. Okay, we've got about 10 minutes left for questions from the audience. Yeah, right in the back, in the middle.
Thank you. My name's Deborah Gilshin. I work for an Australian retirement fund, and we direct all of our voting for our clients and beneficiary shares. And I've worked for two other asset owners, and we always voted our own shares where we could, where fund managers allowed us to. And prior to joining Australian Super last year, I did a piece of work for the Financial Conduct Authority in the UK, creating a voting reporting framework for asset owners to get more information from their asset managers about why they vote. So voting rationales are not standardized across the market. It's interesting to hear about the mechanics of this, but I think we're missing a bit of a fundamental point about why the investment chain is so misaligned sometimes when it comes to voting. Jonathan's research about the fact that generally fund managers don't vote in line with their client preferences. And I think we would do well to spend a bit more time unpicking some of the reasons why that is the case, because ultimately it's misalignment and it's inefficiencies in the voting chain. And I think separately, we talk a lot about the voting part of the investment part of the voting chain, but do companies understand how this could really change some voting outcomes? So, you know, John, when companies engage with BlackRock, do they understand that you don't perhaps own all of you own 8% of the shares, but your team doesn't hold 8% of the voting? And I think that's where sometimes the impact on companies, they could be quite surprised by some of the outcomes that could be coming their way.
I'll let anybody jump in and take it who wants it.
No, you're right. We are transparent in terms of voting choice, the assets that are in it. We don't tell every company, the 13F shows that we own 8%, but we'll be voting 6.2, and then 0.3% will be voted along the lines of ISS SRI, and 0.1 will be voted along. That's not a level of granularity we get into. The new NPX reporting requirements will add some clarity to when there are opposing votes cast at companies.
Dorothy, could I just, this is Teresa here.
Oh, yeah, hey, Teresa.
I want to pile on to your comment. The signaling effect of voting to corporations gets lost if there is not more granularity of choice. So in other words, one of the, in efforts to improve investor corporate dialogue, one of the things that corporations often misunderstand or misread is proxy voting by institutional investors in particular. And there's this belief that if it's ISS or Glass Lewis recommends a certain thing, a block, at least 25 to 30% are going to be voting with that policy. And so I think as we get more choice and there's more large investors voting their own, a lot, the biggest ones do currently, but if you get more and more, the signaling effect of corporations, I think, is going to be stronger. And hopefully we can get rid of this myth that that everyone's just going along with Glass Lewis or ISS, because it's a myth, but it's a one that has a lot of backing, a lot of misperception. So anyway, I think it's a good direction we're headed in.
Yeah, Bruce.
I appreciate the thoughts and comments today. John had mentioned changes to Form NPX.
Mm-hmm.
Would you build on what you mean by that? Because I think what that indicates is that you're going to report shares that are out on loan, but it doesn't necessarily mean that you're going to report how the shares were voted. And so in some respects, there's going to be less transparency about the voting, partly because of pass-through voting.
Mm-hmm.
And so how will the world understand shares that get voted or don't get voted going forward?
Yeah, I'm going to disappoint you on that one, Bruce, which is we're still working through the mechanics of what that's going to look like. There have been all sorts of discussions internally. Do you report on a per voting policy basis? Do you report in aggregate on one and the others? We have not, obviously the report's not due for a couple months, so we're not at a point where we have a solution yet.
But you do need to report the vote string. So, and the shares that aligned with each vote string. So you'll see maybe there is some commonality right across the different policies and how they ultimately voted, but you will see the split or the breakout on the MPX report of, how many shares at this meeting voted for proposal 1 and how many voted against proposal 1 and what's the split for proposal 2 and so on and so forth. So you will have that level of transparency in the MP. Yes.
You'll get the numbers.
Oh yeah.
The hard thing is to tie that back to a voting policy. Unless you have full transparency into the vote strings for each policy, it's hard to tie it back. And then, like you said, Liz, a lot of meetings are uncontested. A lot of companies have meetings where all the vote strings are going to look very, very similar and you can't disaggregate. That's the challenge.
Right. Challenge for Jonathan to the future. Yeah.
I think in the last couple of years, there have been Wall Street Journal articles about a new business. I can't remember what it's called, something like the shareholder voting exchange, which allows investors effectively to sell their votes. And I'm wondering what you think of that, both on a pass-through basis and then to the extent that, votes aren't passed through, but actually voted by the likes of BlackRock. What you think of that from a normative perspective? Is that a good thing? And do you think it has any chance of catching on?
Did I hear it got shut down?
I remember hearing about it existing, but I haven't heard anything since.
Zach, sorry. Yeah, I heard they're gone. It doesn't exist. It's a moot point.
Is it a good idea to let people sell their votes? If you were a policymaker, is that something that you think would be a benefit to our capital markets and to investors?
Jonathan, you want to jump in here?
Yeah, absolutely. This is corporations class red meat. So, of course, the separation of ownership and control is one of the fundamental problems of corporate governance. So, in general, I think the law does try to keep votes with ownership, and I think something that so blatantly separates it is probably a negative, just because whoever's buying those votes is probably paying a lower price than it's essentially distorting the proportions there. So if they have other interests, it could cause bad corporate outcomes.
Great, okay, one more, Eric, we want to.
Okay, this Eric, yep. Me?
Yeah,
Oh,
you.
There was a lot of floating around. I had a question about how, whether this affects, to go back to the climate problem, I think a lot of people were very enthusiastic when BlackRock took a very strong climate view. And a lot of people and other institutional investors making that possible. But doesn't it, do we have something to worry about when we have devolving the choices about voting, that it would be less likely, or they're going to create a lot of knowledge problems about who are the retail shareholders, what are they going to know about these issues? And is it, if you just take a consequentialist view of what will be a big moving power in the market, if BlackRock and other large institutions walk away from that commitment, do you worry, or is there a reason to worry from a policy perspective that individual investors are not going to pick up the slack on that? They're not going to try to make a decision in the aggregate toward that policy.
Yeah, Danielle.
So I don't have a view from a client perspective because we're not an asset manager or a mutual. But I think what we're hearing from our clients is they feel that this is the investor's money at the end of the day, and therefore it's their choice to participate. Now, if the investor doesn't participate because they don't want to, the vote goes back to the asset manager and they apply their stewardship and they'll vote it in accordance to all of the research and all that. But I think it's, from a personal perspective, in terms of democracy, right? Everybody has that right to vote ultimately, whether or not we view them as the most informed or not. They have that ability to vote. So I still think the democratization of voting makes a difference. And even if we don't necessarily think they're putting all that much research in, or analysis into the decision-making process, but it is our job to make sure we give them as much information as possible so they can make.
All right, well, with that, let's give the panel a round of applause. Really nice job. Thank you so much. Oh, come on. Something like that, so I ran off. Geez, I'm a parent also, so I know how this goes. Okay, here's side.
Everything okay?
That's gonna.
It's fine. I want pills. I'm
Sorry, real quick, we have an announcement.
My pleasure, my pleasure.
This versus.
Yes, I just want to announce that that we're officially at the end. And also to thank the panelists and all of you for your discussion and engagement today. I thought it was really, it was from the perspective of what I thought it would be, it kind of fulfilled it, right? Very serious discussion, new stuff. And I thought, it ended on a panel that really is about the future, which is exactly what Columbia, exactly what the Milstein Center wanted to put forward. We thought about the governance issues of the past and, the pass-through voting, there are questions galore that arise from that. So we look forward to John's chance to do empirical work, and I hope all those will be cooperative in that regard. And then in a couple of years, he'll tell us more about how things happened, what it all means. And so anyway, there is, for those who are going to Weil, that's at 4 o'clock. And I think there's time between now and then to travel to 59th and 5th Avenue. So see you soon, let's hope. Oh, and Erica and Molly, thanks again for the great work done in putting all of this together.
No, we're all